So tonight we're going to talk about crypto exchanges, which I think is truly the backbone of the entire industry and something that is rapidly evolving before our eyes here. So we'll dive into the panel. We'll have Q&A at the end, but before we jump in, we'll have everybody introduce themselves. So we'll start right here and go down the line.
Sure, thanks. First of all, thanks, Michael, for inviting me to this event. So my name is Kayvon Pirestani. I represent Coinbase's institutional business, which is headquartered here in New York City. I've been with Coinbase about a year, and before Coinbase, I had a career on the sell side, peddling equity derivatives to global institutional investors. So as most of you probably know, Coinbase is a San Francisco-based technology company, been around since 2012. We came into being as a way to make it easy for folks that weren't crypto experts to easily buy and safely store Bitcoin in a hosted wallet. And since 2012, we've expanded our product offerings to serve many more types of investors. So today we have, in addition to Coinbase.com, our mass retail offering, we have a trading platform called Coinbase Pro for the day trader. We have a full-service institutional brokerage called Coinbase Prime for institutional investors. We have a qualified custody solution called Coinbase Custody. And then finally in Chicago, we have our core matching engine called Coinbase Markets, which is the liquidity source for all the different platforms inside Coinbase. And so Coinbase is today one of the largest players in the crypto space. We're nearly 400 people globally. We custody more than $30 billion in client assets. And by most measures, we're the most liquid crypto exchange in the US for the spot market anyway.
Tim McCourt, Global Head of Equity Index and Alternative Investment Products for the CME Group. Thanks again for having us here, and thanks again for Nasdaq for hosting us here this evening. Looking forward to the conversation. And what I do at CME is I look after the global equity index benchmark products such as our E-mini Nasdaq 100 future. And over the last few years, my role has evolved to include covering the crypto and digital assets, where at CME we view them as an alternative investment product. So my team looks after commodity indices and now the Bitcoin future, the Bitcoin reference rate and real-time indices, and the most recent product we launched out there is the Ether reference rate and Ether real-time index. And we're just really excited to see kind of this market continue to evolve. As Kayvon was saying, it's exciting. It's obviously an exciting time where even myself coming from the sell side before coming to the CME, this also presents new and exciting opportunities for all of us in the more traditional finance space to be part of something exciting, compelling, and I think groundbreaking. So happy to be here.
Awesome.
Great. Cohen from Nasdaq. Thank Michael and team for joining us tonight and helping us partner on this. We appreciate it. So as head of North America, I run our US and Canadian franchises as well as our ETF franchise, and most recently now our digital asset strategy. And so what's Nasdaq's presence in this space? We've had an ETN over in the Nordics, some of you might not know, for the better part of 3 years now. So we were early into the Bitcoin and Ether space, so we have 4 products live there. In addition to that, we have a technology business that's fairly robust, so we're powering a lot of the ecosystem in crypto world, in particular around surveillance. And then on the market data side, we're curating a lot of alternative data sets in crypto world and making sure that it's more transparent, getting that information in the hands of retail and institutional investors. And then finally, on the transaction side, we've been looking at crypto here in the US. We haven't not launched a futures product just yet, and the ETF has obviously been held up by the SEC, but we're definitely interested, and we've kind of just tried to understand the space a little bit better. We've also been monitoring the ICO space because we obviously have an issuer platform and a private market platform. So we're watching some of the spaces and active in others.
Awesome. So one of the first things I'd like to talk about is how we get institutional money into the space as a whole. And I think this is, to me, one of the last big hurdles that we have to make as a market to really become mainstream. As an example, Susquehanna, for any crypto that they hold for over a day, they actually put the keys in cold storage off-site that's not connected to any of their systems to avoid hackers getting in and stealing their crypto. So I'm curious, I would love to start with you. You guys have obviously made a lot of noise with your institutional products. What else do we need to do in order to get institutional money into the market?
Yeah, good question. So this is something that we spend a lot of time thinking about at Coinbase on the institutional side of the business. What are the hurdles to institutional investor adoption of crypto? So whenever I meet an institutional investor who's not trading crypto, naturally I ask the question, what's holding you back? And the answers usually fall into 4 categories. First category is generally conceptual. Like maybe you just don't buy it, you think Bitcoin's a fraud. Second category is reputational. Maybe they're worried that if they trade crypto, something goes wrong, they'll lose their jobs or the firm's reputation might be tarnished. Third category is regulatory. Maybe they're not sure that there's enough regulatory clarity for their firms based on how they're regulated to deal in this asset. And then the fourth is infrastructural. Maybe they're worried that the marketplace and the infrastructure is not reliable or operationally sufficient to support their trading activities. Coinbase is looking to address all of these hurdles, but we're really focusing on the infrastructure piece in particular. We want to build out the building blocks for the crypto marketplace, and we think there's 3 main building blocks that we're focusing on. The first is exchange or trading venue. So as I mentioned, Coinbase Markets in Chicago is a low latency, dedicated hardware environment with colo capability that we're going to be releasing towards the end of this year. The next piece is custody. So most large investors in the US who invest money for third parties are required to hold their assets in qualified custodian. So Coinbase Custody that we're in the process of launching meets that need. And then the third piece is a margin finance capability. You can't really have an asset class that you can't leverage or short. So we're in the process of building margin finance capabilities into our Coinbase Prime platform. And we think those will help really address the infrastructural needs.
Mm-hmm. Yeah, I would say some of the things that Kayvon was talking about too are also some of the motivations for CME to introduce a financially settled future on the Bitcoin reference rate, because it was attractive to the institutions for a few reasons. The one being is that it was financially settled. It plugged and played like an existing contract. It gave them the exposure they wanted to Bitcoin, but they necessarily didn't have to get involved in handling the digital asset Bitcoin itself. It worked in their trading systems, it worked for their clearing members. You just had to move US dollars at the end of the day. But then I think when you kind of go beyond introducing that ease or access point, it actually was also, as CME as a regulated futures exchange, we were able to deliver a product that was trusted, that it was efficient, that it was fair, that it was regulated. And that really starts with how we designed the product, even the fact that our futures contract overlies the Bitcoin reference rate, where we have multiple spot exchanges contributing prices such as Bitstamp, Itbit, Coinbase, and Kraken, that we actually are trying to design a reference rate that a futures contract can settle to that is also more resistant to manipulation. So when you have a trusted product, a regulated marketplace that's financially settled, you're eradicating some of these barriers for institutions that want exposure but want to do it in a way that maybe they don't have to have or handle some of these challenges that Kayvon were saying at these early stages. So I think that will continue to grow. And I would say the other thing on the institutional front that I find very fascinating is when you look at the marketplace participants and how it's kind of balanced across the spectrum in terms of you have people who are hedging Bitcoin that they've accumulated through open market transactions or maybe through mining. You have people who want to use it as an alternative access point. And then you have people who are outright speculating or trading or kind of swing trading around the volatility. So the institutions that are developing their strategies around crypto trading and Bitcoin are using kind of traditional tools in a new offering such as Bitcoin Future. And I think that's also very compelling to see that institutions are getting more and more involved.
Anything to add, Tal?
Yeah, I'll highlight 2 things. One is regulation. We think a lot of folks on the institutional side sit on the sideline until there's clarity on the regulatory side, because if you're an asset manager that's fairly highly regulated and you're holding billions of dollars of assets and you're thinking about getting into crypto and you think it should be part of your portfolio, you'll want to understand the regulatory impact of that on you. So that's one. And then the other one is just maturity of the ecosystem, maturity of the infrastructure. It's as simple as how do I actually put up a trade? How does my workflow look like? To how do I provide margin? To is there a derivative product? Is there an ETF? What does the ecosystem looks like so I can get exposure efficiently into these products, which you can't yet get. And that only comes with maturity and transparency. And so most folks we talk to want to see it on exchange. And a lot of crypto still is off exchange for the most part. And so once that on-ramp is there to bring it on exchange, bring more transparency, clarity on regulation, and build out the ecosystem, you will see larger money managers start to think about it as part of their portfolios. But right now, it's a really difficult task for them. And that's beyond the issue of custody, settlement, and security.
And so right now we're talking about simple access to, I think, the more common tokens, Ethereum, Bitcoin. There were 4 billion in ICOs last year, almost 10 billion in ICOs already this year, and a lot of variety across those ICOs. And there's a lot of demand also for different tokens. And I know Coinbase has done a lot here. You guys recently acquired Keystone. Circle's working towards getting its banking license. Nasdaq, so on and so forth, are working towards becoming an exchange where you can list all of these things. What needs to be done for investors to have access to more variety in the market?
You want me to start?
Please.
Sure. So I guess broadly speaking, we see an increasing overlap between the world of traditional securities exchanges and so-called crypto exchanges, where you'll start to see crypto assets listed on traditional exchanges and traditional assets listed on crypto exchanges. And I think it's pretty obvious why, say, a Nasdaq or traditional marketplace would want to list a crypto asset, because there's clearly large retail demand for that out there. But I think a more interesting question is, why would the likes of a Coinbase, which is a crypto-first company, want to potentially list so-called traditional securities? And one reason is that the crypto marketplace, unlike traditional marketplaces, tends to be more global. It has broader distribution, and it operates 24/7, 365. And we think this is particularly interesting for less liquid asset classes that need better price discovery, transparency, and liquidity. For example, recently I've had conversations with clients who are working on projects to take illiquid assets like private equity, real estate, or even artwork, tokenize that, and put it on a crypto exchange so it can more readily have price discovery and liquidity, something that wouldn't be possible otherwise.
Any other perspective here?
And from what perspective? So can you repeat the question for me?
Yeah, there's a lot of variety in terms of the different tokens out there, right? And we were just talking about Bitcoin and Ethereum. There's hundreds of others at 10 billion in ICOs this year, beyond just the upfront regulation and everything else. What else needs to be done on the exchange side?
On the exchange side, so I'm going to separate it from the primary market activities and the secondary market activities. So from the primary market activities, Nasdaq has kept a close eye on the ICO market. We have a view about what an ICO is in terms of a fundraising event. And so we think we can add value there, but we're being cautious based on what we're seeing today and what's coming into the market today. So there could be a role, I think, over the long run, once again, regulatory clarity is provided on the primary market side. And I think that could be really interesting for traditional exchanges like us. On the secondary market side, I think the point that Kayvon brought to our attention, which is there's a circadian rhythm of how this trades across the globe. Like crypto trades differently than an equity, because equities, we turn it on, we turn it off, it's highly regulated, and investors in particular geographies trade that, and then they go to sleep at night, and then it comes back up in the morning. And so with crypto, we just have to think about it slightly differently, like the futures world to some extent, but that circadian rhythm is different in terms of the trading patterns that we see. So for us, we have to think globally. We can't think locally, and that's a big difference for an incumbent exchange where you're located in a particular jurisdiction and regulated by a particular regulator. So to think that way requires us to have assets and capabilities across the globe, and I think only a few players will actually get there at the end of the day and be able to do what is needed in that space. And one other point I'll just draw is in terms of just adoption, crypto is somewhat tied to distributed ledger technology uptake. So as there will be more uptake on the DLT side, and decentralized applications have real use cases, you're going to see crypto assets valued differently, because there will be real investment thesis behind some of this instead of what's driving some of the market, not all of it, but some of it, which is speculation, volatility, and purely the enjoyment of being in the investment itself.
Yeah, I think those are defining differentiators, particularly on the global front, and then in terms of time to trade, much like the FX market. And so as we look at the way the U.S. equities exchanges have evolved, there's effectively Nasdaq and NYSE. How do you think the market will unfold from an exchange standpoint in crypto? And we'll stay with you down at the end.
So from our perspective at Nasdaq, we look at it and say, what does it have to look like, and how does it have to be regulated to be on an exchange where either the SEC or CFTC in the futures world will look after this? And so We think the natural maturation of it will go a little bit like this, where you'll want to understand all the risk management techniques of an exchange, how we bring buyers and sellers together, how we essentially blunt volatility during times of market duress, how transparency helps price discovery in ways that yet aren't really connected in crypto world. So there's crypto exchanges, there's a lot of locked markets, there's a lot of cross markets, which means that they're just not integrated yet. So we see if this actually gets to the point where classical exchanges like us are in the business, that will mean that the exchange fabric will be highly integrated. People will get price transparency, but also they won't see dislocation between one exchange or another exchange, and it will be a harmonized set of rules that indicate how trading will take place. And so when we think about our exchange business in a traditional sense, we're there for our customers during times of market duress. So when there's low volatility, low volumes, you have a lot of optionality in how you trade and where you trade. But when things get difficult, that's where you look to the exchange to make sure they mitigate your exposure in that particular instance. And so our clients depend on us to bring buyers and sellers together as efficiently as possible during those 10 to 20 to 30 days a year where there's a tweet from our president saying one thing that drives the markets one way, and there's somebody else talking about the markets in a different way, and then we need to bring those buyers and sellers together efficiently.
And I think the one thing I would add to that is when you're looking at the development of the ecosystem that we're kind of talking about here, there's obviously high degrees of interrelatedness between the different markets. And I think when we look at traditional markets and what's encouraging about the digital asset market, when we look at something like the Bitcoin market, is that this interrelatedness is starting to form. You have price discovery occurring in the futures market. You have price discovery occurring in the spot market or the digital market or the underlying market, kind of whichever way you would like to describe it. And people are starting to trade between them. They're starting to develop the mechanisms by which to transfer this liquidity from one source to the other. How do they keep these markets efficient in line? And you look at it, they're highly symbiotic over the long run if we look at how other markets have developed. And it's key to foster that interrelatedness such that market participants can help other market participants transfer this risk, because everyone might have a different point of preference of how they initiate or how they evaluate that how to trade decision. Do I want to trade on a futures market? Do I want to trade on a spot market? Do I want to trade in a non-US market or an OTC market? And all these participants, it's really a global marketplace, and they're operating in various parts of this ecosystem. So the extent by which all of us as exchange operators can foster that symbiotic nature and that interrelatedness, I think that's really what's going to be attractive to the end customer and make for the ultimate most efficient and most transparent market.
Kayvon, anything to add on that? No? Cool. And so, Tim, I'd love to stick with you. So CME recently launched the Ether reference rate product, and I think there's a lot of room here for some unique products to come out of this market. I'm curious if there's anything you guys have talked about or anything that you think could be interesting or unique to the crypto market in terms of a brand new product for investors.
Yes, we first launched the Bitcoin reference rate back in May of 2016 and just recently announced the Ether reference rate and the Ether real-time pricing index. And I think what's interesting to look at it is we spent a lot of time developing the methodology where, I kind of was saying earlier, it's really important for us to have this reference rate or kind of this index approach. We kind of favor that both for a few reasons where we think it allows for a more resistant index or rate for a futures market, but it also looks to aggregate some of the various price contributions across the spot market. So when we look at the Bitcoin reference rate, where we had the 4 spot exchanges, that kind of is covering 30 to 45% of the Bitcoin dollar spot market. We look at Ether, where we have 2 constituent exchanges, Bitstamp and Kraken, and that covers about 20% of the Ether dollar market at this point. That's helpful for price discovery. It's helped to kind of get that tried and tested data set and what is that reliable price source on a daily basis, and then a kind of a tick-by-tick basis. But when you look at some of the other assets that are out there, the other tokens are out there, there will be a trade-off between the methodology and can the methodology support other tokens? Is there enough participants? Is there enough diversification? There are certain guidelines around the index creation or the reference rate creation that each constituent exchange must meet a minimum contribution in a pro forma. They're constantly being evaluated, and they have to agree to a certain set of rules and guidelines, and there's an oversight committee that looks after these reference rates. So I think even as the tokens become more important in the broader ecosystem, the challenge is not everything is always ripe for that kind of reference rate product or derivatives product development. So I think it's balancing between the two of how do you maintain the integrity of what you're trying to establish, how do you meet customer demands and enable their risk management, because there's probably more things that people want to trade than are suitable for what we're trying to achieve.
Awesome. So Canaan has invested in fintech for a very long time, and we believe strongly that to be successful in fintech, you have to work with the regulator, and I think that's probably more true for this market than any other. There's been countless stories around money laundering. Justice Department just launched a criminal probe on investors manipulating markets, so on and so forth. Can each of you spend a little bit of time talking about what you think good regulation looks like? And we're always trying to balance between protecting investors and their money and also optimizing around innovation. So I'd love to start with you, Tal, at the end and hear your perspective on that.
Yeah, so this is a subject that's near and dear to our hearts because at Nasdaq, we actually have a surveillance platform that's fairly widely adopted. It's called SMARTS, and it's adopted across asset classes, across geographies. And so when we thought about, if you will, adding crypto to that and how would we do that, we think about the following, like in the futures world, let's just take a simple contract like what CME has. For Nasdaq to get in the game, we actually have to understand the underlying spot market. We have to know that the spot market is surveilling their customers. They do KYC, they have AML, they understand what they're doing. They have some semblance of surveillance at that level. Then you need to have some level of communication, dialogue between the underlying exchange and the, if you will, the derivative exchange. And so that dialogue needs to be coordinated because sometimes in crypto world, which is different than some others, you're going to go cross geographies. So it won't be just SEC, CFTC. It will be some other regulator that needs to play a role. So how does that actually work in traditional asset classes? It doesn't actually work that well. So this is going to test the limits of how regulators cooperate. And so if there are going to be different rules in EU versus the Americas versus in Japan where it's legal tender, it's actually going to create some really interesting dynamics of where liquidity goes, because it will go where it's most welcomed. And so when we think about surveillance, there's going to have to be coordination. There's going to have to be coordination between regulators, between exchanges. And at the end of the day, they're going to have to do what we normally do in any other asset class, which is know your customer and be able to tell people, because in Bitcoin world, we get a lot of news comes out about like 50% of Bitcoin is owned by this type of person or this type of activity is being conducted. I think the more we can be transparent with what's actually happening, who owns it, what they're doing with it, will only help the growth of this asset class.
So before we come down the line here, I do want to stick on the KYC AML because we just invested in a company that's doing this specifically for this market, and we're calling it KYA, Know Your Address, right? It's interesting because it goes completely, counter to what some of the folks in this market stand for, and some of the libertarians, and some of these tokens are structured around anonymity, which, from an AML KYC standpoint, just screams regulation. Is there just a segment of the market that's never going to come online for that reason? Or I don't know if you have a point of view from a technology standpoint, but how is that going to work?
So that's interesting. So there's the privacy coins you just mentioned, and that actually brings a different challenge. But so what's really interesting is, and we know, is law enforcement and regulators are already joining forces around exactly what you just said. And there's companies like Chain Analysis that are doing really, really good work. So reg tech as an industry is under a boom. It's like under a renaissance, if you will, because of what's going on right now. And I actually think at the end of the day, the regulators will figure out things that are on the ledger, that are immutable and that are transparent, are actually easier to follow. And you can see what's happening across the globe and trace it a bit more, if you will, a bit easier than you could in things in the black market. So I actually think there's a renaissance here. It's actually, the tide will turn, but it'll only turn when we provide more information to the public domain about what's really going on.
Yeah. And get your questions ready. When we're done here, we'll open it up to the audience. But in the meantime, Tim, would love to hear what does good regulation look like for us?
Yeah, I think when obviously, CME is a regulated exchange, and that's something that's very important to market participants and our customers. And I think it's very important that you work with the regulators as we're looking into new and innovative technologies and products, because the regulation has to balance the needs to remain, for the marketplace to remain innovative, for us to answer the evolving risk management needs of customers, but to make sure we deliver that trusted, tried, efficient, and fair marketplace. So that's obviously a balancing act and something that needs to evolve over time. Things that we're dealing with in the Bitcoin space is different than things that necessarily we dealt with in historical products that we've launched. So it requires an ongoing conversation. It requires coordination, requires the resolve to remain committed to operating a regulated, fair, and efficient marketplace. So I think it requires input from all stakeholders, whether they be internal to the exchange at CME, whether they be participants or people who are thinking about getting in the market but have concerns. We need to be nimble, and we need to be responsible, and we need to be adaptive as we all kind of collectively blaze this trail forward.
I guess on our side at Coinbase, I guess I'll start by pointing out that there are many crypto exchanges out there that are not embracing of regulation or are fundamentally opposed to the concepts. Coinbase is very much not that way. We obviously embrace constructive regulation. We think it helps create a fair and trusted marketplace and ecosystem. That's the first thing I'll say. What does constructive crypto regulation look like? I think Japan is a great concrete example. I spent 5 years of my career in Japan. In Japan, I think it's struck that balance of fostering innovation whilst protecting investors. But the other thing the regulators in Japan have done is provide clarity about what is okay and what isn't. And so if you look today, the announcement the SEC made about Ethereum not being a security, this is a great step in that direction, and I'm pretty excited about continued clarity here in the US as well.
Awesome. Questions from the audience? Please. So I'll repeat it for the crowd, is what does each of our organizations look like, 5 to 10 years from now, and what is the grand vision? And we'll start here and put you on the spot.
Sure thing. Great question. And yeah, I think it's really important to remember that crypto is so much more than just a trading asset, although that's one of the main use cases today. So Coinbase's mission as a firm is to create a more open financial system using crypto technology. Today that happens to mean a lot of trading products, but in the future we see things like identity on the blockchain, stable coins, relays, and decentralized exchanges and things like that, which provide access to more people around the world in a more equal way that are not necessarily just linked to speculation on price. We think ultimately that's what our mission is as a firm.
I think from the CME perspective, as we continue down this trail of launching Bitcoin futures and launching the reference rate and the real-time pricing products, is for us, we want to continue to enable our customers to manage their risk. And there's a new risk profile evolving in the crypto space or the digital asset space, and we want to continue to operate that marketplace for people to come and transact their risk. As Tal was saying earlier, as an exchange operator, we're fairly agnostic to the price movements of the asset. It's just that when someone wants to buy or sell, they can do so efficiently, and they can do so with confidence. And that's what we're really looking for. I think down the road, when we kind of look at competition is immensely healthy in something like this. It breeds and fosters innovation. It allows for new things to be developed because people have to differentiate themselves from each other, and collectively the right solutions will avail themselves. I think that culminates in the establishment of liquidity, of price discovery. So I think those are things maybe like further down the road. It's interesting to see how like the spot market or the digital market and the futures market and the ETF market, how all these things will coalesce and form that liquidity pool for the market. I think that's exciting to be part of, and I think that will remain a focus because that's where risk will be transferred amongst participants. And I think that will be our primary driving force is continuing to meet the demands of our customers so they can do that efficiently.
Yeah, so at Nasdaq it's fairly simple. We actually think the technology will live up to the hype over the next 5 to 10 years. So right now, there's scaling problems, performance problems that just don't allow it to scale in the way that you can actually trade on that platform in the way that you want. But we think that the technology will get there. And so we think it's an asset class that we want to embrace and we want to amplify. So how do you do that? We have a technology, we sell technology, we talked about our surveillance technology, we talked about the transaction business, and these gentlemen just articulated how we can all do that and be part of that. But what's really interesting is we take this asset class, we might be like dragging it to commercial adoption, because remember, it's there because it's censorship resistance. That's like one of the biggest qualities of all this, that it's decentralized. And to the extent that you're asking Nasdaq and others to get into the game, we're somewhat centralizing that. And so there'll be this push and pull of, we get this asset class as it matures, as the scaling problems goes away, as we provide more transparency to regulators and to investors, we're still going to have to bring it from where it was and what it was designed to do to something that's mass and commercially available to all of you to trade in the way that you want. I think that push and pull is going to be really interesting, but the technology itself, we believe in it. We believe in DLT. We think that decentralized apps, as I said before, as that's embraced, it's going to help crypto. It's going to help the use cases and the understanding of Ether. What is Ether? Well, it helps decentralize apps. Well, how does it do that? Show me a use case. Today, it's kind of hard to do that, but in 3 to 5 years, I think we're going to get there.
Yeah.
You mentioned decentralized exchanges. You guys just purchased, was it Paradox?
That's right.
Recently. What role do you think that's going to play, particularly on the institutional side? Do you see that in the future there's going to be non-custodial trading on the institutional side, or is that more for the retail investor? How do you see that kind of panning out?
Yeah, really good question. Frankly, I don't think we know the answer to that yet. There's some clients I've talked to on the institutional side that are scared by these so-called decentralized exchanges and relays because you don't know who's out there trading against you. But there are other folks, particularly on the more proprietary trading, high net worth or active individual trader side, that are incredibly excited about these types of exchanges. So what we're doing at Coinbase is to basically foster the commercialization and development of the technology, put it out there, and see where it grows, see where it goes. And given our user base of 20 million plus retail investors, as well as a substantial number of institutions, give appropriate users access to technology and see who provides the uptake.
Well, 2 more questions right here.
Yeah, I have a question regarding stablecoin and how that's going to impact the roles and relationships. So since we have one from digital asset exchange and also traditional asset exchanges, how do you think the kind of proliferation of a stablecoin will impact the role and relationships between traditional and digital asset exchanges? And for digital asset exchanges, both fiat and non-fiat, how do you think the landscape is going to change?
Would you like to take this?
There may be like 3 questions in that question.
When I say 2 questions, I think
That's
we're
a
out of time.
compound question. Which part of the question do you most want an answer to?
Yeah, stablecoins, how that's going to impact the roles and relationships.
Does everyone in the audience know what a stable coin is, first of all? It's a little bit of an esoteric topic. So basically, just a nutshell summary, a stable coin is taking a traditional financial asset whose value is relatively stable with respect to something else like the US dollar or gold or oil and tokenizing it and putting a crypto wrapper around it. And it's one of the lubricants in the crypto marketplace where you can send dollars using crypto blockchain mechanisms around the world without actually sending the dollars themselves to get around a lot of the limitations in traditional finance.
I think not necessarily specific to the stable coin question, but I think, the kind of like digital versus traditional exchanges is that right now there's so much technology kind of being developed that we purposefully went into the financially settled contract first that moves only fiat dollar, right? That does, like I was saying earlier, plugs and plays with our existing network the easiest. We continue to look at innovations in the space. We're watching the custody market. We're watching as people are finding how do they kind of create like merchant banking services in this, because I think the bigger thing that we're looking at is you have the advent of kind of crypto-only firms and crypto-only institutional accounts where they have they're crypto rich and fiat, poor. Like they're not liquid in the traditional fiat sense. So I think those are the things that are going to are more interesting to watch. But from our perspective in the exchange right now, it's very important for us to kind of focus on that dollar fiat movement, because frankly, that's what works for most of the people and is the easiest for people to adopt. So I think right now that's where our focus is, but I think when you look at the general technology that is kind of popping up around this proliferation, I don't think it's just a stable coin question. I think it's a general servicing question that people are trying to develop solutions for, and it's fascinating to watch. So we're interested in where that's going, as I'm sure some of the other panelists are, but I think it's a little early in the game to say for certain what the long-term impacts will be.
Yeah, and I'm just going to, Kayvon said something really interesting, so I'm going to just jump on that for a second and kind of go off tangent a bit. But ETFs, I'm going to do an analogy with ETFs. ETF essentially is technology. It's a wrapper around an investment that you have today, but it's more efficient. It's made that investment product easier to get in and out of. There's certain advantages to that product over buying the securities that underlie that product. What he described is the tokenization of something may make it more efficient, may actually make it easier to transfer around the world in different ways that you can't imagine today. And so that's like what the ETF wrapper did for investments. It was like investments 2.0, mutual fund 2.0. So when you think about the securitization or when you tokenize securities, that's to some extent what I think we're talking about. That's how the world will look like, and that will be ubiquitous. Everybody will benefit from that kind of technology adoption, and that's what's really exciting about it.
I'll take one more. I saw you first.
This is mostly a question for Canaan, but for the others as well. With, like you said, $10 billion going into ICOs, do you view that as a threat as a venture capitalist, as far as being able to access capital greater? And then for the exchanges, are you worried about people not listed because they're staying private longer, being able to access more capital from investors in a more democratic way?
It's a great question, and I think the last time the VC industry was asked this was around crowdfunding, right? And there were a lot of folks that were funding projects around crowdfunding. I think this is different in a couple of ways, and one is the decentralization that you talked about, right? As you think about the VC model, it's 2 and 20. We collect a 2% management fee, 20% on carry. That 2% is to manage a fund and to manage companies in a very centralized way, sitting on boards and helping them to operate and really kind of dictating the way companies are built. That is completely counter to what everybody's doing in this market here. So we've invested in a number of SAFs, and as we do it, we've kind of, we're dipping our toe in the water because it really is tough for our model because we can't company build the same way we do with our other businesses. And the second thing is, from a technology talent standpoint, we're seeing some of the best talent in tech go to these projects and away from companies where we're investing traditional equity in. So I think what we have not yet seen are some of these newer projects and products actually built on top of them that are going to be sustainable. So TBD on how big that is, but it's absolutely something that we're thinking about. And you can see a world where VCs are, traders, and we're kind of getting in and out of positions and working with different companies over time. But in terms of today, there's still a lot of really interesting technology companies raising capital in traditional ways. And we've also seen, because of the regulatory framework, a lot of very high quality teams back away from going down this route just to be safe for the time being. But it's absolutely something we're thinking about. Well, thank you all for being here, and thank you to the panelists. Quick round of applause.